Two people can live in the same country, buy the same car, rent the same apartment, apply for the same loan, and somehow they are not living in the same economy. One person gets the low rate. The other gets the expensive rate. One person gets approved instantly. The other has to pay a bigger deposit. One person gets cheap insurance. The other gets told their neighborhood is too risky. Same product, same country, same market, different price. That is the strange part of the modern economy. It is no longer just pricing things. It is pricing people. For most of history, we imagine markets as places where goods had prices. A house costs this much. A car costs this much. A loan costs this much. But modern finance changed the question. The question is no longer only, what is this thing worth? The question is, who are you? What is your credit score? Where do you live? What do you earn? How stable is your income? What device are you using? How risky does the system think you are? The old economy sold products. The new economy sorts people. And the first sorting machine is credit. A credit score looks like a boring number, but it is closer to a financial passport. It decides how expensive money is for you. If your score is high, money becomes cheaper. You get better loan terms, higher limits, lower deposits, and more choices. If your score is low, money becomes expensive. You pay higher interest. You need more cash up front. You get fewer options. And one mistake can follow you for years. This is one of the strangest facts in finance. The people who need money the most often pay the highest price for it. From the bank's side, this is rational. Higher risk means higher interest, but from the borrower's side, it creates a loop. A higher rate makes repayment harder. Harder repayment creates more risk. More risk means worse terms next time. The machine does not just measure risk. Sometimes it manufactures it. Then there is the zip code. A zip code looks like an address, but to the financial system, it is a data package. It can imply income, crime, school quality, disaster risk, property values, medical access, and insurance losses. Two people with the same income can move to different neighborhoods and suddenly face different versions of life. Different car insurance, different home insurance, different rent, different school options, different asset appreciation, different exposure to floods, fires, crime, and pollution. Location is no longer just geography. It is a financial label. Your neighborhood can raise or lower the price of your life. And algorithms made the sorting invisible. In the old world, rejection was obvious. A banker said no. A landlord said no. An insurance company sent a letter. In the new world, you may never know what happened. You just see a higher price, a lower limit, a worse offer, a longer wait, a bigger deposit, a less favorable recommendation. You were not rejected. You were sorted. And that is harder to fight because nobody has to say the quiet part out loud. The app just shows you the price. The platform just gives you the options. The algorithm just says, this is what you qualify for. But behind the screen, the economy is ranking people, not morally. Financially, how likely are you to repay? How likely are you to cancel? How likely are you to switch? How much can you be charged before you leave? How many alternatives do you really have? This is where finance and technology merge. Because the most powerful companies are not always the ones with the best product. They are the ones that know how to separate customers. Who gets the discount? Who pays full price? Who needs credit? Who can be upsold? Who has no alternative? That is not just marketing. That is pricing power. And Wall Street loves pricing power. A company that can charge different customers different prices is more valuable than a company forced to charge everyone the same. An insurance company wants to separate low-risk customers from high-risk customers. A lender wants to separate prime borrowers from subprime borrowers. A platform wants to know who is price sensitive and who is trapped. A landlord wants to know who can pay more. A fintech company wants to know who needs money right now. The better the sorting machine gets, the more precise the pricing becomes. And the more precise the pricing becomes, the less equal the economy feels. Because people stop seeing one market. They start living in different markets. There is a cheap economy for people with assets, high credit scores, stable income, and good zip codes. And there is an expensive economy for people with volatility. Volatile income, volatile housing, volatile health, volatile transportation, volatile credit. The irony is that instability itself becomes expensive. If your life is predictable, the system rewards you. If your life is unstable, the system charges you more. That is why being poor is not only having less money, It is being forced to buy money, housing, transportation, and insurance at worse prices. The rich do not just have more dollars. They often get better prices on life. They can borrow against assets. They can wait. They can negotiate. They can leave. They can self-insure. They can pay up front. They can choose. Choice is a financial asset, and the sorting machine knows who has it. This also explains why inflation feels different for different people. Official inflation is one number, but your personal inflation depends on what the system has sorted you into. If you own a home with a fixed mortgage, inflation feels one way. If you rent and renew every year, it feels another way. If you have good insurance, one price. If your insurer leaves your state, another price. If you have access to cheap credit, one economy. If your credit card charges 29%, a completely different economy. So when people say the economy is doing well, and other people say the economy is terrible, they may both be right. They're just living in different layers of the sorting machine. For investors, this matters because the sorting machine creates winners. Credit bureaus, insurance companies, payment networks, data brokers, fintech lenders, advertising platforms, real estate platforms, risk analytics companies. These businesses do not just sell products. They sell classification. They help the economy decide who gets what, at what price, and on what terms. And classification is becoming one of the most valuable forms of power. Because in a world of infinite products, the scarce thing is not always supply. Sometimes the scarce thing is being treated as a good customer. The old economy asked, how much money do you have? The new economy asks, what kind of person does the system think you are? And once the system answers that question, everything else changes. Your interest rate, your rent, your insurance, your deposits, your offers, your waiting time, your mistakes, your second chances. The economy is becoming a sorting machine, and the most important price may not be the price of a stock, a house, or a car. It may be the invisible price tag attached to you,